Good evening, everyone. Welcome to tonight's webinar. I'm Carl, one of the coaches from Ronovationz. For those who don't know Ronovation, we are one of Auckland's leading property investment group. We've been operating for more than 10 years. And so tonight, we are going to talk about cash flow versus capital growth. Now, a bit of disclaimer before we go. Tonight's presentation will be general information, okay? So don't take it as a personal advice. Now, when it comes to property investment, there are generally two ways to do. One is invest for cash flow, and the other one, invest for capital growth. Okay, now the first one, cash flow, usually that offers higher rental growth, higher rental returns, more than average. So you have a bit of extra cash in your pockets. The second one would be capital growth, which you enjoy much higher capital growth. Let's look at the two different strategies. What's the pros and cons? First one, for cash flow. Now, the good thing about cash flow strategy would be you are getting some regular income and you have some surplus to cover after all expenses. So from day one, you'll be cash positive. And the better thing about this strategy would be cash flow property usually have little capital growth. And since you are earning, have surplus, you won't be able to enjoy tax benefits. Instead, you're going to pay tax. Now let's look at the capital growth strategy. The good thing about capital growth strategy would be, in the long run, the value increase outweighs the cash flow benefits. And because initially most property in this category will be negative geared, so you are able to enjoy some tax benefits. And of course, LVR, it will be in favor to you because banks normally are more comfortable to lend for properties for this type of properties in good areas, in desirable location, in big cities such as Auckland. Now the downside of this kind of strategy would be because cash flow is negative. That means you need to fork out money from your own pocket to cover some extra expenses to supplement your tenants to live your properties. So what's the best option? Well, now it all comes down to what your goal is and where you are financially. So it all depends on your current circumstances. But there are a few considerations to take into account. Okay. Now, do you want to increase your personal wealth, or do you want a source of income? And if you want to significantly increase your personal wealth, then you should choose a capital growth strategy. Now, as a general rule of thumb, capital growth is best for investors aged between 20 and 60 who are still accumulating their wealth. Now, by high growth properties, we allow these investors to get the benefits of something called compound growth, right? And as their properties rise in value and they can accumulate significant personal growth. As if you are near retirement, of course, you will have created the wealth required to live the type of lifestyle you want. However, you also require a source of income if you're no longer working. So this is when a cash flow strategy is necessary, as investors can use rental return as passive income. And while you are young and haven't got much financial liabilities, I believe a growth strategy would be ideal. If you have enough income and lower responsibilities to support it. But when you are near retirement and have more responsibilities and lifestyle expenses, then positive cash flow investment may be a better fit. Now, if your goal is to build a wealth, definitely capital growth is much better. Is the better way to go, because real wealth comes from doubling your property value as many times as possible. Now, it's easy for beginner investors to simply chase the positive cash flow for that instant income. But in reality, if there is no capital growth potential, they could be cutting themselves short on equity to expand their portfolio. We will say slow and steady wins the race. Of course, cash flow is a great and necessary part of building a portfolio, but the true wealth creator is capital growth. So investing with a long-term outlook works best. Remember, property investing is not a get-rich-quick scheme. Well, if somebody tells it is, they are being less than honest with you. And now, sure, sometimes the market will deliver some great returns in very quickly in the short term. But overall, you need to remember that time is your best friend when it comes to investing in property. So as history showed, in New Zealand, real wealth comes from doubling your property every 7 to 10 years. And the properties needed to build a cash flow portfolio are usually where? Would be in regional or on the outskirts of major cities. And you are lucky if regional properties double in value every 15 years. So if you buy a $500,000 cash flow property and assume it double every 15 years, then your initial investment should double twice in 30 years. So from $500,000 to $1 million to $2 million. While this may seem a lot in today's money, it won't buy much in 30 years. If on the other hand, you invest $500,000 in a growth property and assume it double every 7 to 8 years, then your initial investment should double 4 times in 30 years, from $500,000 to $1 million to $2 million to $4 million, and eventually should reach around $8 million, which is a huge difference. So growth asset offers the only genuine path to creating wealth when investing in properties, as you never achieve real wealth by trying to supplement your income. Now let's look at positive gear and negative gear properties. So as you know, positive gear property usually would be cash flow properties, and negative one would be growth properties. Of course, cash flow keeps you in the game, but capital growth gets you out of the rat race. Let's look at an example. If you buy a property which generates $100 positive cash versus another one, you need to fork out $100 to supplement the property. Which one is better? Of course, if you just look on the face, it seems cash flow one is better. But if the cash flow one doesn't give you much capital gain, and the one is negative one can bring you much more capital gain, say in a few years, it grows more than 200K, you are able to recycle the equity out, maybe 150K as a deposit to buy another $500,000 property. And if you're going to rely on cash flow, which is $100 per week, $5,000 per year, how many years does it take to accumulate enough as a deposit to buy the next one? It's far too long, nearly impossible. So the best way would be to build assets first, then transition to the cash flow stage later. Now you may ask, are you able to get a balanced portfolio which enjoyed both capital growth and cash flow? It is impossible as long as you know how to choose the right properties in the right location. Firstly, location got to be in good place. If you choose a location which can bring you good enough capital growth, you can choose the right type of properties which will bring you great cash flows, such as units or home income types of property in good location. And if you know how to buy well, use good strategies. For example, to buy under value, you gain capital growth straight away. And if you know how to add value, for example, renovate it, make extension to the property, you not only enjoy capital growth, you also enjoy cash flow straight away. So it is possible, like I said, if you know how to do it. So you don't need your properties to cost anything to hold, all right? The property you select can be growth focused, but have strong demand for rental. And they are therefore can be cash flow positive right after renovations or a few years later as rent rise. So what's your choice? Of course, your choice needs to fit your goal, also to fit your profile. But if you're not sure which direction to take, don't gamble with your financial future. Reach out to an expert for professional guidance. Talking to your friends at a barbecue and decide you want to do what they have done probably won't work, as there's never a one-size-fits-all solution. So it's always good to really make sure that what you're doing fits your profile financially, and also, of course, your risk profile. It is important that investors work with a property investment advisor who can advise you on the most suitable properties for your own circumstances. That's pretty much for tonight's webinar. If you got any questions, please send through. And okay, we got some. Right. We got a question here. What effect will possible the capital gain? Capital gain tax. Okay. Capital gain tax, as we know, is not going to be implemented already. So if you are using long-term investment strategy, there's no capital gain tax unless you're doing flipping, right? If you buy and sell, then you pay capital tax. Right, if you have any other questions, you can put it through. Now, before I'm waiting for more questions, I'm going to let you know that we are having more webinars coming up in the next few weeks. Will be another 3 on the line. You can register for those one. Also, we have property workshop on 14th of September, and you are more than welcome to register. For detailed information, you can check on our website. If you don't have any other questions, let's call it a night. And so we're looking forward to see you in the next few webinars. Thank you, everyone. Good night.